Three things about the Great Depression everyone misunderstands. Everyone points to the stock market crash of October 1929 as the trigger, the initial spark. But that's only part of the story, and arguably not even the most devastating part. The real catastrophe, the one that crippled American households and businesses for a decade, unfolded not on Wall Street, but in thousands of small towns and bustling cities across the nation, in the quiet, unassuming halls of local banks. Imagine a sound, a constant low thrum just at the edge of hearing, but only you can hear it. That's what it was like for millions of Americans, a growing unease, a silent dread that their life savings, entrusted to their local bank, might simply vanish overnight. This wasn't just fear. It was a rational response to a system teetering on the brink. The banking system of the 1920s was a patchwork quilt of over 25,000 individual institutions, many small, locally owned, and critically uninsured. If your bank failed, your money was simply gone. There was no FDIC to step in, no government guarantee. This structural vulnerability was a ticking time bomb. The first major wave of bank failures actually predates the '29 crash, starting in the agricultural sector in the early 1920s. Farmers, hit by falling crop prices after World War I, couldn't repay their loans. When farmers defaulted, the small rural banks that had lent to them started to crumble. But the true epidemic began in late 1930. The Bank of United States, a large New York institution with nearly 500,000 depositors, collapsed in December. This wasn't a small rural bank. This was a major metropolitan player. Its failure sent shockwaves, transforming localized anxieties into widespread panic. A bank run at its core is a crisis of confidence. It's a self-fulfilling prophecy. When rumors spread, true or not, that a bank is in trouble, depositors rush to withdraw their money. Banks, by design, don't keep all deposits in their vaults. They lend it out. So, if too many people demand their cash simultaneously, the bank runs out. The psychological contagion was brutal. One bank's failure could trigger panic in a neighboring town, even if that second bank was perfectly solvent. People saw their neighbors losing everything, and naturally they rushed to protect their own savings. It was a domino effect, accelerating with terrifying speed. Between 1930 and 1933, nearly 9,000 banks failed. Think about that number. 9,000 financial institutions vanishing. This wasn't just an abstract economic event. It was millions of individual tragedies, dreams shattered, futures erased. Small businesses couldn't get loans, families lost their life savings, and communities disintegrated. One of the profound ironies was that many of these banks were actually solvent. They held good assets, loans to reliable businesses, mortgages on valuable properties. But those assets weren't liquid. They couldn't be instantly converted to cash to meet the demands of panicked depositors. The Federal Reserve, established in 1913 to provide stability, largely failed in its primary duty during this crisis. It was supposed to act as a lender of last resort, to provide liquidity to sound banks facing runs. But the Fed often hesitated, fearing moral hazard, or simply not understanding the scale of the unfolding disaster. When the Fed did act, it was often too little, too late. Banks that desperately needed temporary cash injections were denied, pushing them over the edge. This exacerbated the panic, further eroding public trust in the entire financial system and its supposed guardians. President Herbert Hoover, a man of great intellect and humanitarian spirit, found himself overwhelmed. His administration clung to a philosophy of limited government intervention, believing that the market would correct itself. But the market, in this case, was in freefall, pulled down by a collective loss of faith. The ripple effect was catastrophic. With banks collapsing, credit dried up. Businesses couldn't borrow to expand or even maintain operations. This led to mass layoffs, unemployment skyrocketed, and consumer spending plummeted. The entire economic engine sputtered to a halt. Farmers, already struggling, faced even greater hardship. With banks failing, farm mortgages were called in. Unable to pay, many lost their land, forcing them into poverty and contributing to the desperate migrations chronicled in works like The Grapes of Wrath. By 1932, the situation was dire. The economy had shrunk by almost half. Unemployment reached 25%. A quarter of the American workforce had no job, no income, and little hope. The banking crisis wasn't just a symptom, it was a primary driver of this economic devastation. The election of Franklin D. Roosevelt in November 1932 signaled a desperate plea for change. His inauguration in March 1933 came at the absolute nadir of the crisis. Almost every state had declared a bank holiday, effectively closing all banks to prevent further runs. Roosevelt's immediate action was decisive. A nationwide bank holiday. All banks closed for several days, giving his administration time to draft emergency legislation. This bold move, while terrifying for depositors, bought crucial time and signaled a new resolve. Within days, the Emergency Banking Act was passed. It allowed solvent banks to reopen under federal supervision and provided them with much-needed liquidity. Crucially, Roosevelt delivered his first fireside chat on March 12, 1933, directly addressing the American people. His calm, reassuring voice explained the situation, asking Americans to trust their government and the banks that would reopen. He famously said, "It is safer to keep your money in a reopened bank than under the mattress." This direct communication was pivotal in restoring public confidence. When banks began to reopen, the runs stopped. Money flowed back into the system. This wasn't a complete fix, but it was the vital first step in stabilizing the financial sector. The immediate panic was quelled, allowing the long, arduous road to recovery to begin. The lasting legacy of the banking crisis was the creation of the Federal Deposit Insurance Corporation, or FDIC, in 1933. This guaranteed individual bank deposits up to a certain amount, fundamentally changing the nature of banking in America. It removed the existential fear of losing everything if your bank failed. The Great Depression wasn't just a stock market crash. It was a systemic failure of trust, amplified by an archaic and vulnerable banking system. The bank runs, fueled by fear and ultimately leading to widespread failure, proved that confidence is perhaps the most fragile, yet most essential, commodity in any economy. Understanding this period isn't just a history lesson. It's a stark reminder of the interconnectedness of finance and human psychology, a cautionary tale about the dangers of unchecked fear, and the critical role of robust institutions in preventing economic collapse. The banking run epidemic of the Great Depression was a wound that festered for years, a testament to how quickly an entire nation's wealth can evaporate when faith in the system is lost. And the lessons learned, particularly about deposit insurance, continue to shape our